Invite Ed Yardeni, President at Yardeni Research, on the show now. Ed, thank you very much for joining up, staying up late. Let's begin with the super strong jobs report that we got. Just 1 week back, we were actually talking about the Challenger grade report, which said the job losses in the US in the month of January hit the highest level since the global financial crisis. Then 1 week later, we're hearing about, the jobs increase being 75,000 more than expected. So tie in, these two contrarian data points. And what is your reading of the jobs data?
Well, any data that supports my optimistic outlook is good data, and the rest of it should be ignored. But seriously, I think the Challenger data, when you compare it for January, is yes, that's true what you said. But the reality is, at the end of last year, for many months, it was very, very volatile, going up and down. And meanwhile, it was not really confirmed by what I think is the most important indicator of layoffs, and that's weekly initial unemployment claims. And instead, initial unemployment claims were declining late last year. And I thought that that was signaling that we might get a better than expected employment number in January. And that's exactly what happened. It was certainly better than I expected or anyone expected. But this may be the beginning of a stabilization of the labor market. And I think we're going to see an improvement in the labor market this year. I think too many people have been coming up with too many excuses of why employment's weak. And there was a lot of uncertainty last year. And I think things are clearing up now, and we'll see the U.S. economy doing better, a lot of stimulus up ahead. And I think we'll see the labor market doing better as well.
And morning, is it the kind of jobs which, in a way, white-collar jobs? I mean, is that? Have you looked at the data? Some are pointing out that, well, the number looks good, but jobs which well-paying jobs which support consumption and kind of sort of have a wider multiplier effect. I mean, what's happened there in this report?
Yeah, well, in this report, you continue to see that a lot of the employment is happening in the healthcare and social services area. So maybe that's not white collar, but it's white coats. I mean, the healthcare industry is a huge industry in the United States. Baby boomers are retiring. They're getting older. There's tremendous demand for healthcare, and those are very well-paying jobs. In addition, we did see a reasonably solid increase in construction jobs and in manufacturing jobs, and those are well-paying jobs. I think overall, we have seen wages going up since the pandemic. The minimum wage used to be below $10 an hour. Now it's like $25 an hour in places like Amazon and Walmart. So I think when you look at inflation-adjusted wages, they're actually at an all-time record high, and they have been driving purchasing power and consumer spending.
Hi, Ed. Good to see you, Ed. I wanted to ask you about, what's going on in Japan. Earlier this week, we had the Liberal Democratic Party that had a resounding win out there.
Right.
How do you see, what kind of impact can it have, both on the currency out there, as well as on the central bank action? Because one of the fears for global equities was that the Bank of Japan goes ahead and hikes rates. So your comment on that.
Well, it's interesting that the bond yield obviously has gone up dramatically over in Japan. Back in 1983, I coined the phrase bond vigilantes, and it certainly looks as though the bond vigilantes are very busy in Japan. But most of the debt that the Japanese have, particularly government debt, is owed internally. So they don't really have the exposure to foreign investors who tend to kind of bail out before domestic investors. Meanwhile, the inflation rates actually come down. The overall inflation rates come down to 2%. I think the government clearly has a mandate now, and they're going to and the government has the power to institute some fairly significant fiscal stimulus, defense spending, and kind of geopolitically aligning themselves more with the U.S. relative to China. So you put it all together, and I think the outlook for Japan is actually pretty good, and the stock market there has been clearly demonstrating that.
Ed, what's your view on the U.S. software names? ServiceNow is down 30% since the start of the year. Salesforce has declined nearly 27%. So while you're bullish on the overall markets, this is one part of the market, the software, and now the anxiety is spilling over even to the financial sector. And that's a pocket which is deep in the red. What is your call on software?
Well, in early December of last year, I said it's probably time to go from overweight the Magnificent Seven to underweighting them because I perceived that there was just increasing competition among the Magnificent Seven. It was kind of like Game of Thrones, where you had 7 independent kingdoms that operated without getting into each other's way. And suddenly with AI, they're all competing with each other and they're all spending huge money on data centers. And there's a lot of known unknowns. We don't know whether the rate of return on this investment is going to be significant or not. So I still think that the whole technology area is certainly having an issue with AI. For a while there, the AI trade was to buy anything that had to do with AI. Now, I think investors are buying what I call the AI immunity stocks, which companies aren't likely to be overturned, overthrown, disrupted by AI. And software clearly was sort of the leading indicator of let's think about every company that we own in our portfolios and assess whether AI might be disruptive to that company. So guess what? It kind of gets people to invest in the old economy, in energy, in industrials and materials. And that's what the market's saying, and that's what makes sense to me.
Yeah, no, absolutely. Ed, we'll leave it there. Thank you very much for joining us. And as always, great speaking with you. So much happening. And Ed, of course, making sense of all of it for us here. We'll take